This week we've got RBA announcement on interest rates. We're expected to get a quarter. We've got the US downgrade. Moody's finally pulled the pin on lowering the US credit ratings. Basically, University of Michigan's consumer index fell to 50.8, second lowest reading ever, and one-year inflation expectations jumped to 7.3%. And of course, as I mentioned, RBA meets this Tuesday. The market's expecting 0.25% again. But first of all, let's have a look at what's happening in the States, because the US futures basically, after the market closed, dropped about 300 points. And that's purely because Moody's credit ratings have basically lowered their rate one notch to a AA1 from a AAA. Now, the significance of that, well, we've already seen S&P and Fitch's move on those rates before. This was a while ago. But to see Moody's move, I think, it's actually quite interesting, because they've obviously seen a little bit of light there in terms of the US credit, and there is, because in the one major fact that is actually occurring is we've got $606.5 trillion worth of US debt, which will be rolled over. Now, when Moody's made their move, they basically said, well, okay, they're concerned about the US's economy to be able to pay the interest repayments. Now, that's quite important, because when you have $6.5 trillion rolling over, it's going to be rolled over at a higher rate. So there are these growing concerns, these fiscal concerns, which are starting to evolve. Moody's expects the federal debt rate to increase to about 134% of GDP, in more the long term, 2035, 10 years out. So I think that to me is a real concern. So it's that ability of that interest payments, those interest payments which they're going to have to meet. Now that's going to create a problem, and more so a problem when the government's debt to GDP ratios are significantly higher. And it's all about servicing, not repaying. And nobody in the States, as we know, except hopefully Donald might look at it, actually look to repaying that debt. So that is a bit of an issue. Now, as a consequence of what's happening there in the States, in terms of Moody's, in terms of that interest repayments, there are these negative things which are starting to come up, and I think we're going to see some shifting capital away from the States over time. That's something we have talked about in the report, and that's a consequence of what's happening with the tariffs. With the way the US economy is structured at the moment, I don't think it's strong enough to be able to weather what we're seeing in terms of Trump's policies, and that's why we still remain relatively short in the equity markets. Time will tell. Now, to contra to that, a lot of people have said to me, "Oh, look at the numbers, look at the US reportings. They were all pretty stellar," and they were, and there's no doubt about that. The reportings were very, very positive. However, at the end of the day, when you look at it, that's more of a lagging indicator, not a leading indicator. So you want to see more the expectations of how these companies are going to go, given that the tariffs are in play, and given the way trade, because at the end of the day, we think the consumer, particularly the US consumer, are the ones that are actually going to lose out here. And to me, that is one of the areas, because it'll falter through, and we'll see more cash moving from the States into other trade areas. Now, the interesting theory on the equity markets is that you look at some economies, like for instance Germany and the DAX. The DAX has actually traded to record highs. Obviously the US market hasn't. So what's actually happening there? We're seeing this cash moving from the States into Germany, or people seeing those other economies which have this ability to benefit more so out of the trade picture, the changing trade picture. If you're going to trade with the States, it's going to cost you. But if Australia, for instance, is going to trade with Germany, it's not. So at the moment, we're talking about these bilateral arrangements, which are obviously trade-free. So all of a sudden, you're seeing this whole shift in dynamic for trade. Like Australia's sort of going to reduce its trade with the States, and it'll go and trade with other people. And I think that you'll see more of it. And I think at the end of the day, as I've mentioned, the US consumer will be the only ones that are going to lose out on this, because it's a global economy. So people just move to where they make money. That's away from the States and into other areas. So let's see how that unwinds. And I actually do think that will unwind into a negative story for the US. Okay, now let's look also, University of Michigan came out with some inflation data, 1 year expectations. Now that to me is a big number, because and that's why we're seeing some support to the gold. And in my mind, when you look at it, the 1 year inflation expectation jumped to 7.3%. The highest I said there was 1981. Now that's going to see gold, and in the report we've actually looked at gold again, thinking that like it's going to have another run to the top side. It's going to have a run to the top side, not just because it's a store of value, but also because the dollar, the US dollar, should weaken over time given this new opening to new trade areas. And I think as a result of that and these new markets that all the other economies are actually going to be looking at, so people will say I'm going to move away from the US, and that's really got to hit on the price of gold. So I think that to me is pretty good. Let's see how that unfolds. Okay, China. Now today we had some good numbers. Well, not as good as what we'd expected, but still quite positive. Industrial production, where it grew by 6.1%. Now that's a little bit back from last month, but it's still quite positive, and I think that's really important. Last month we had a 7.7, which was actually huge, but to come back sort of makes sense. But let's hope that 6.1 is more the trend, and sort of the 7.7 is a trend, and we're coming back and we'll move higher. But if it starts to go lower, that is a little bit of concern in terms of our inflationary expectations. Also, we saw the retail sales figures came out. Not that positive. Retail sales they rise, which is good, 5.1% year on year. But certainly off from the 5.9% we had in March. So is this recovery, the green shoots of recovery we always talk about, is that now starting to come back a little bit? And to me, that's a little bit of a concern there. But annualized rates they've always averaged, or they're not annualized. The retail sales have always averaged about 12% since 1993. So if anything there, we are on the lower end still, but that's also an economy which is transitioning, and we can't get around that. So let's see what happens. We really want to see that. The picture still remains mixed in China. That to me is a little bit of an issue. Whilst it remains mixed, it's very hard to take more of a lead in terms of investment. Okay, RBA this week, Tuesday, announces interest rates in Australia. Do expect 25 basis points. In terms of that, whether or not we'll get some wording around, it'll be the last one for a while, who knows. I think the concern is that as long as the price pressure's there, then I think you'll find that the RBA will be happy. Remember, they were very lagged in terms of putting interest rates lower, just like the US. But if the numbers sort of back it up, which I think they do, people are going to expect that 25% basis cuts, and that hopefully will start to support the economy. So let's see what happens there. Okay, overall this week, just on terms of the economic numbers, we're sort of expecting not a lot out, so I don't expect too much movement and shaking in terms of economic numbers. We've still got some good numbers out of China and Euro as well, but nothing major out of the States, so it should be quite quiet.